Hello students, so welcome back to class number 31 on financial analysis and planning. So we are discussing on this ratio analysis and financial ratio analysis. So we discuss about all the profitability ratios, activity ratios, long-term solvency ratios, short-term solvency ratios, and we saw one example problem in our last class. And now we are going to see little complicated problems. So let us discuss some few problems. So moving to the first problem, this looks like a very simple problem. Maybe you get in a 2 marks or 3 marks question, but you have to do it correctly. uh, a company has a profit margin of 20%. They have not given gross profit margin or operating profit margin or net profit margin. Don't worry, you have to take it as net profit margin. And asset turnover of 3 times. Asset turnover we discussed in the last class, which is sales divided by assets of 3 times. Okay, of sales divided by fixed assets 3 times. What is company's return on investment? How will this return on investment vary? If there are 3 scenarios that is given, how the return of investment will vary? There is a very simple formula. What is net profit margin? Net profit divided by sales. What is asset turnover ratio? Sales divided by fixed assets. If we multiply these two formulas, net profit divided by sales multiplied by sales divided by fixed assets, so sales will cancel each other, then it becomes net profit divided by fixed assets. What is fixed assets? It is the investment that you have done on the fixed assets. What is the net profit? That is the returns you have generated for the particular period. So return on investment is nothing but the product of net profit margin multiplied by asset turnover will give you the return on investment. So what is the return on investment? 20 percentage multiplied by 3, it is equal to 60 percentage. Next, what are the 3 scenarios? Profit margin is increased by 5 percentage. So 20% becomes 25 percentage multiplied by 3. Return on investment will be 75 percentage. Next, asset turnover is decreased to 2 times. So 20 is the net profit margin multiplied by the fixed asset turnover. From 3 it has come down to 2. So your uh, return on investment will be 40 percentage. Next, profit margin is decreased by 5 percentage from 20 by 5. So 15 percentage is the profit margin, and asset turnover from 3 it has gone to 4, which means multiplied by 4. So the return on investment is 60 percentage. 15 percentage multiplied by 4 is 60%. Very simple problem. I think you may get something similar to this in your examination also. So that's why I brought in for our video also. Next, we for the next problem, the difficulty level is little bit higher. Let's yes. So this is the following balance sheet is given for the year ended 2015. Okay, so what are all the detail given? Equity share capital is given. Yes, this is the shareholder fund. Preference share capital is given. This is also a shareholders fund. 16% debenture is given. It is a long term debt. Okay, debenture is a debt. Okay, long term debt. Next, 18% public debts, it's also a long term debt. Next, bank overdraft is a current liability. Okay, bank overdraft, it's a short tenure loan that bank has provided to you, so it's an current liability. Okay, next, creditors is you have to pay to the vendor, that's also a current liability. Outstanding creditors. Okay, next is proposed dividend, so you have proposed some dividend, okay, in this year, so that is also lying in the balance sheet. So proposed dividends is also form part of current liability because you have declared a dividend and you have proposed this, you will pay it in next 4-5 months. So that is proposed, that is also form part of current liability. Next, reserves, general reserves is also a shareholder fund. Next, provision for taxation. So we have given provision for current year taxation, the provision has been created. So which means this will also be paid after the completion of your statutory audit. So 20,000 provision for taxation also to be paid less than 1 year, so it should be treated as current liability. Profit and loss account, so this year P&L account balance is also coming here, so this will also be like a shareholders fund. Next, cash in hand, yes, it's a liquid asset. Cash in bank is also a liquid asset. Bills receivable is a current asset. Investment is a current asset. They have not given long term investment, so investment is a short term. So We have to consider as a short-term investment, which is current asset. Debtor is a current asset. Stock is a current asset. Yes. Furniture is a fixed asset. Machinery is a fixed asset. Land and building is a fixed asset. What is goodwill? Goodwill is an intangible expenditure. And preliminary expenses is given. So friends and students, so when preliminary expenses and goodwill is coming, you have to reduce this from the shareholders fund to find the correct shareholders fund. So let's see that in this. So what is asked here? Let's see. Provision for taxation during the year. So it is a current liability. Dividend was proposed 10,000. So during the year, so the dividend is proposed. That is also current liability. Profit carried forward from the last year was 15,000. So profit to be carried forward was 15,000 is a profit that will be carried forward. So you are required to calculate short-term solvency ratios and long-term solvency ratios. So first we will calculate the short-term solvency ratio. What are short-term solvency ratios? Current ratio, okay, liquidity ratio, super quick ratio, debt service coverage ratio. All this four in detail we saw in our last video. Okay, in class number 30. Please watch that in the class number 30. And now we are going to see how to calculate this. So for current ratio, what is required? Current assets divided by current liability. So we have to find the current assets and current liability. What is current assets? Cash in hand is a current asset. Cash in bank is a current asset. Bills receivable, debtors, and stock. All this put together is a current asset. You can total it. All the detail is given in the question itself. You can total it and find the current assets value. What is current liability? Bank overdraft. I have seen many students missing this. Bank overdraft is a current liability, but it is not a liquid liability. Okay, so when calculating liquid ratio, we need liquid assets divided by liquid liability. Liquid liability, bank overdraft is not a liquid liability, but it is a current liability. So creditors is a current liability. Outstanding creditors, which means you have not paid them on the right time, you have to pay them as soon as possible, so it is a current liability. Next, proposed dividend. Yes, this year you have to pay it. Provision for taxation is also for during the year. It is given the question. So we have to pay it at the end of the statutory audit. So all this value is also given. You can find the current asset very easily, current liability very easily, but you have to be very careful while calculating current liability. Out bank overdraft is a current liability. Outstanding creditor is a current liability. Please have these two things in the mind, so you can find the current ratio perfectly. Okay, so there is no doubt in this. Next is liquid assets. So very simple, current assets minus inventory or current assets minus stock is going to give you the liquid assets. So no doubt with the liquid assets. Next is liquid liability is very simple, current liability minus bank overdraft will give you the liquid liability. Liquid assets divided by liquid liability, it will give you the liquidity ratio. So this is also very simple. Liquid assets divided by current liability is also liquidity ratio. So there are two formulas. Liquid, so you can put those two in your paper, or you can put liquid assets divided by liquid liability. When the liquid liability come into picture, only when bank overdraft is there. If bank overdraft is not there in the balance sheet, then current liability is equal to liquid liability. Okay, since bank overdraft is there, it will be there in the current liability, but liquid liability you have to take that out. So simple. Okay, so when bank overdraft is there, apply liquid assets divided by liquid liability as liquid ratio formula. Okay, next is super quick assets. Very simple. Debtors will take time to encash. Bills will take bills receivable will take time to encash. So liquid assets minus debtors minus bills receivable will give you super quick assets, and super quick assets divided by current liability will give you super quick ratio. Very simple. Okay, so all these are very simple. Next, what we have to calculate, debt service coverage ratio, which means ability of our company to service the debt. How to service the debt? By paying the interest. So ability of our company to repay the interest. So what is the profit after tax that is given in the question? Okay, profit after tax is given as 15,000. Okay, profit carried towards from the last year is 15,000. Okay, so profit after tax is 15,000, that is given because that is the profit carried. Okay, profit after tax is 15,000. Interest is given. Okay, you have debentures and public debt. So 16% on 40,000 and 18% on 20,000. If you total it, you will get total 10,000 as the interest, and profit after tax 15,000 plus interest of 10,000 divided by interest of 10,000. So you are getting debt service coverage ratio of 2.5. So very simple. Okay, here you have to qualify your answers. What is qualification? You should just not leave the values, because this is a ratio analysis. What is the information you are perceiving? You have to mention that. Okay, if you see current ratio, what our study material prescribe is ratio 2 is better, so we are lesser than the better ratio. What does this say? Our current assets are more, or our current assets are lesser than prescribed, or current liabilities is more than the prescribed. That's why your ratio is lesser than the expected ratio. Ideal ratio is 2, which means current assets is 2 times of the current liability. That is an ideal ratio. Here it is less. So which means short term solvency is under problem. Okay, you have to increase your current assets. Okay, you have to, maybe debtors you have to realize soon, you have to increase the cash balance, you have to increase your debtors, increase your sales, then credit sales, increase your debtors. Okay, you have to increase your current assets. Okay, and current liability you have to try to reduce, and then your ratio will become better. So these are all some explanatory statements. You can qualify your answers, that will attract the examiners. Yeah. Okay, next is liquid ratio. Ideal is 1, which means liquid assets is equal to liquid liability. That is the best ratio, but here we have got 1.15, more than the better, which is good. Okay, liquid ratio is very good. Okay, next is super quick. It is 0.09. Here there is no ideal thing that is prescribed. 0.09 is the quick ratio. Next is debt service coverage ratio. 2 times itself is better, but we have 2.5 times, which is more better. Okay, we have the ability to repay the rent interest 2.5 times. Okay, so that 2.5 times it's better. Okay, now we will go for the long term solvency ratio. So what are the long-term solvency ratio, debt equity ratio, fixed assets ratio, for which all the details that is required we are going to calculate now. What is long-term debt? 16% debentures, 18% public debt. Total, you can find what is the long-term debt taken by the company from the bankers. Next, long-term fund. What is long-term fund? What are all the long-term money that we have received for our long-term investments? So long-term debt we have calculated above 60,000. So 60,000 is brought in here. Okay, next is equity. It is given in the balance sheet as 1 lakh. Preference is also a long term. Next, reserves is also a long term. Next, our P&L balance is also a long term. And we have to reduce our goodwill, which is intangible portion, and preliminary expenses. From this 10,000 minus 10,000 minus 35,000 to find the long term fund. Okay, in our last problem which we discussed in our last class, goodwill or preliminary expenses was not there. Here goodwill and preliminary expenses is there. So I have seen many students miss this from while calculating the shareholder fund and long term fund. While finding the long term fund, you calculate all the long term fund and minus the intangibles like goodwill and minus the preliminary expenditures that you have done. Same way for shareholders, from equity is taken, preference is taken, and reserves is taken, P&L balance is taken, reduce the preliminary expenses and goodwill. So you will get the shareholders fund. Next, fixed assets that is given. Furniture is a fixed asset, machinery is a fixed asset, land and building is a fixed asset. Total you can find the fixed assets. Now what we have to find? So debt equity ratio, there are two formulas: long term debt divided by shareholders fund or long term debt divided by long term fund. Okay, so we can apply it. So lesser than 2 is good for the debt equity ratio. It is lesser than 2, that is very good. Okay, and it is only 0.16, it is very good. So which means our debt is very less compared to the shareholders fund. Okay, the company is very cautiously taking the debt. They don't want to go into the interest burden, so they are cautiously taking the debt. Next is fixed assets ratio. So fixed assets ratio is fixed assets divided by long term fund. So fixed asset ratio is 0.91. Okay, so ideal is 0.67. 0.67 is best. Okay, we are more than that. So here higher is better or lower is better? Okay, lower will be better. Why? Because long term fund will be utilized for creating fixed assets as well as developing your core working capital. What is core working capital? For there will always be some raw materials held in your warehouse. Okay, there will be always money blocked by some raw materials or finished goods that is lying in your warehouse. This is a core working capital. It may come down, it may go up, but there will be a portion always sitting. Okay, that those things are all core working capital. So you have invested more in fixed assets compared to your long term fund. Okay. So you a portion you have to keep it for working capital purposes. Now you are keeping only very less portion for working capital. How much you are percent? See, 91 percentage is fixed assets. Out of the long term fund, 91 percentage you have invested in the fixed assets. Okay, only 9 percentage you are investing in the core working capital. Okay, so you have to decrease your exposure. How to decrease? Fixed assets put into more use. Okay, or if some unnecessary fixed assets is sitting in your balance sheet, sell the fixed assets. Okay, optimize your fixed assets. So these are all the decisions that we can take from this. Okay, now next we can move for the next problem. Okay, so this is the next problem. There is a Sun Limited balance sheet is given, equity share capital is given. This is a shareholder fund. Capital reserves is given. That is also a shareholder fund. 8% market mortgage loan is given. This is long-term debt. Next is trade creditors is given. This is current liability. Bank overdraft is current liability, but not liquid liability. Okay, taxation portion is given. Current taxes is given. This year you have to pay 2000. So this is a current liability. Future is not a current liability. Okay, next profit and loss account 12,000 is given, that is the profit. Transferred to reserves, paid out as dividend. Okay, so 6,000. So profit P&L account balance is 6,000. This is also we will treat it as shareholders fund. So total of the balance sheet is given. Next, goodwill is an intangible asset. While calculating the shareholders fund, we have to reduce the goodwill. Okay, remember that very carefully. And preliminary expenses, here preliminary expenses is not there in this problem. Fixed asset is given. Stocks is a current asset, but it is not a liquid asset. It is not a liquid asset. Very simple. Debtor is a current asset, also a liquid asset. Investment, it is not given long-term investment, so it is a short-term investment, so it is a current asset. Cash in hand is a current asset, is a liquid asset. It is a super quick asset also. Okay, so very simple. We have almost discussed everything, but we will see cash in hand plus investments plus debtors plus stock is going to give you the current assets. Very simple. What is current liability? Bank overdraft, creditors, proposed dividend, provision for taxation. Current year provision for taxation is only 2000. So this 2000 you have to take it as current liability. There is no dividend proposed. It is already paid out. It is not sitting in the balance sheet. They have reduced 12,000 minus 4,000 minus 2,000. Only 6,000 is coming. So dividend should not come. You have to be very careful in this, students. So in last problem we had proposed dividends is sitting in the balance sheet, not yet paid. So that is a current liability. Here we don't have it as a current liability because it is already treated as paid. So it is 0. So current liability is found, current assets is found, current liability is found. Current assets divided by current liability is going to give you current ratio. Okay, next is liquidity ratio is going to be liquid assets divided by liquid liability. What is liquid assets? Liquid assets is current assets minus inventory or current assets minus stock. Stock value is already given, it is 6,000. Okay, so liquid assets is found. What is liquid liability? Liquid liability is current liability minus bank overdraft. Bank overdraft, it is 2000, it is given in the question. Okay, so liquid assets is found, liquid liability is found. Liquid assets divided by liquid liability is going to give you liquidity ratio. Next is super quick ratio, for which you need to find super quick assets. What is super quick assets? Liquid assets minus debtors minus investments. We don't know when these things will come, maybe 1 or 2 months. Liquid means readily available cash. Okay, so that is super quick assets. So super quick assets divided by current liability will give you super quick ratio. Very simple. As discussed in the previous answer, qualify the problem. So current ratio 2 is better, you are on lesser side, which means your short term solvency has to be improved. Liquidity ratio 1 is better, but you are more 1.4, which means your liquidity ratio is very good. Okay, which means liquid assets is calculated by reducing the stock. You are having more stock. Okay, your liquidity ratio is better than ideal, but your current ratio is poor than ideal. What does this show? You have more stock. Maybe non-moving stock is sitting in your inventory. You have to analyze your inventory. Whatever is the unwanted materials that is sitting in your inventory, which is not required for production itself, those things you have to liquidate it, or you have to scrap it if it is not required at all in the future, but with consensus of the technical team. Okay, so that is this is called the qualification. You can put these remarks or write these things so that your one who is evaluating your answer sheets will be more inspired or more attracted. Okay, so next is the profit after tax. Yes, 12,000, that is given. Profit after tax is 12,000, and interest is 8% mortgage loan you have, so 16,000 multiplied by 8% is 1280. So interest, okay, profit after tax plus interest divided by interest is 10.38 times you are covered. You are covering your interest. Your income is 10.38 times more than your interest. So which is very good. So 2 times is ideal, but you are 10 times. That's great. Okay. So which means you have calculated all your short term solvency ratios. Now next we will go for long term solvency ratio, but before that, see in the question, testing liquidity. Testing liquidity means short term solvency ratios. Testing solvency, solvency means in the long term the company has to be solvent. Okay, so which means that is long term solvency ratio. Now next let's go for the long term solvency ratio. So what are the long term solvency ratio? Debt equity ratio, we have two formulas: long term debt divided by long term funds, or long term debt divided by short shareholders fund. Fixed assets ratio is fixed assets divided by long term fund, which we discussed in our last problem, which is very easy. So 8% mortgage loan, 16,000 you have taken the loan, that is long term debt. Long term fund, very important, long term debt plus equity plus preference plus reserves plus P&L plus future taxation. You have kept a provision for future taxation, very important. Here you will go wrong. Okay, future taxation. Current taxation is current liability, future taxation is long term fund. Okay, you have to reduce the goodwill. Preliminary expenses also you have to reduce, but in this question preliminary expenses is not given. Okay, reduce the goodwill, you can find the long term fund. What is shareholders fund? Equity plus preference plus reserves plus P&L minus preliminary expenses minus goodwill will give you the shareholders fund. Next, fixed assets, it is given in the question itself as 28,000. Okay, so long term debt divided by long term fund, calculate the debt equity ratio. Long term debt divided by shareholders fund is another formula to calculate the debt equity ratio. So we have applied the two formulas to calculate the debt equity ratio. Debt equity ratio is less, should be less than 2. It is less than 2. It is very good. The long term solvency looks very good. Okay, next is fixed assets ratio. Fixed assets divided by long term fund, it is 0.78. Ideal is 0.67, which means more long term fund you have invested to buy fixed assets. Maybe those fixed assets are not utilized properly, or unwanted fixed assets you have bought. Liquidate it if it is not required. Scrap it with management's approval if it is not required for future purposes. Okay, so this is the ratio that is given. So here ideal is better, more is not better. Okay, if more is, if it is more than 0.67, which means more long term fund you have invested in the fixed assets itself, then how you will invest in the core working capital. Okay, so that is the thing I wanted to cover it for the day. We will see with the upcoming problems very soon. All the very best, students. Thank you.